Hey everyone, welcome back to my channel. So today I wanted to talk about what is really affecting people when it comes to buying a home. So everyone was saying that debt is king, debt is cheap, that you should continue to buy now as debt is cheap. You should buy FHA loans, only put 3% down, all that stuff. So with those who put 3% down in late 2022, you're now seeing housing prices go down. And because of that, they're underwater on their home. Essentially, you cannot sell your home for any sort of profit. So those who put 3.5% down, they typically are needing home values to appreciate. But with the Fed raising rates, that is now lowering demand, and therefore, instead of your home appreciating in value, it's depreciating in value. And so with only having 3% down, you have zero skin in the game, and that is putting you underwater. This is where you're going to see a lot of defaults on homes in 2023 and 2024, because nobody wants to pay for a home that they overpaid for. Especially when they don't have any money in the house, they're more likely to just let it go and maybe move in with a family member or move in with a partner. So we see this all the time, especially back in 2008, when you buy a $100,000 house for just $3,000 or $3,500, and now that $100,000 house is worth $20,000, and you don't have the money to cover that spread. You got $80,000 gap in between. You might as well let that go. And that's the mindset that many people have had. So if you're buying $1 million house today, most millionaires will buy that home with a adjustable rate mortgage, because they don't want to finance $800,000 worth of debt at 7%. They want that at 2%, 3%, even 4%. Right? Because that's going to allow them to use massive amounts of cash to do other things. So if that $1 million home now is worth $600,000 and they're $400,000 underwater, and they know that with their job, with the type of money that they need, that they may need to travel from California to New York, or New York to Ohio, or Ohio to Miami, Florida. They understand that with their job volatility and the amount of travel that they need to do, that they may not be in a home for more than 3 years. They are also more likely to default and let that go. So it doesn't matter about how rich you are or how or what process you in life, because the people that I've seen when I was a home lending advisor who would take out those adjustable rate mortgages are
Welcome to Pennsylvania.
Are typically those who are making millions of dollars a year. And so they don't want to have their money tied up like that, and especially in a depreciating asset. They only want their money in appreciation of assets, because when times are good, those $1 million homes can now sell for $3 million in just 1 year. All right? But when times are bad, those $1 million homes can be worth $600,000. So those are the homes that typically fluctuate the most, because there are less people who can afford those homes. Therefore, there are less buyers for those homes. And so your market is much smaller than somebody who buys the average home like $460,000 to about $200,000. Those are where you'll see the majority of people buying, and therefore the rate of which those houses will decrease in value are much lower. And then the increase is also going to be much higher, adjusting for what people can afford. So in this time, you see people just playing on the sidelines, because they know with these higher rates and these high housing prices, they're simply not able to afford it. So what is going to give first? Well, rates were increased in order to lower demand. With lower demand, you are going to decrease the prices of homes. A decrease of 20% is what the Fed is looking to get. How much money down do? Most investors have to put down 20%, right? So if the Fed is looking to decrease exactly 20%, then you will see that people are even on their homes. The difference is that if you bought at 3, 4, or even 5%, although you have zero equity, you still have a cheap rate. And then when houses do go back up, you are still locked in at a better rate than those who are buying at 6 or 7%. And so you see no reason to sell, because now you have married the rate rather than the equity in the home. However, if you had bought at 6, 7% and now you have zero equity, and then demand is still low because the interest rate is high, that is when you will see a correction. Now that prices have dropped, interest rates will come down ever so slightly, and now you can refinance into a better situation. But here's the thing. You cannot refinance. You can do a rate and term refinance where you have very little equity, and then you can go FHA rate and term refinance. But most people, I would suggest, should go conventional, which means at least 5% equity in the home in order to do a conventional refinance. Understand that in refinancing, you are also going to have to pay closing costs, which is going to be covered through that loan. So if you only have 5% equity in your home and you're doing a refinance rate and term, your closing costs that you're covering is probably going to put you in an FHA situation, which is going to give you permanent PMI for the entirety of the loan. I don't want my listeners to have permanent PMI. Yes, a FHA has a cheaper interest rate, but with the PMI, you're going to be paying more than a conventional mortgage. And then a conventional mortgage, typically that PMI drops off after you hit about 20% equity in the home. A lot of people can hit 20% equity in the home with just the appreciation of the home's value, or just waiting it out year by year until you get enough to that 20% mark. For example, when times are good and you're at a 3% rate, you're able to get to your PMI goal without putting any additional income in at 5 to 7 years. But now with rates being at 6%, you might have to wait 8 to 9 years in order to get out of PMI. And most people do not stay in their homes for more than 5 to 7 years. So this is a long-term game, because they say that real estate is a long man's game, right? It's an old man's game. It's not something that you can do quick and make a whole bunch of money. Although we have seen that in 2020 and 2021, right? So you cannot just be the average Joe. You cannot be the average individual. You cannot do what the average do. If you decide that you're just gonna hold the home for 5 to 7 years, you're doing what the average does, right? And then you're basically going to give the banks the majority of your money, because they are front loading most of their costs on your mortgages on the initial years. So when you just started building equity in your home and you're at that 10-year mark, and now you're seeing most of the equity that you're putting towards your payments going towards you, you're now in a position to where every single month that you pay your mortgage, that's more money in equity and savings being put towards you. But if you're always refinancing or selling and going into a new home every 5 to 7 years, you will realize that you're never paying yourself more than you're paying the banks. So you have a question to ask yourself. Would you rather continue to pay the banks more, or would you rather pay yourself more? So I'm giving you guys a lot of information in this short video, because it's really a question of how you want to live your life. I'm not saying one is better than the other, but for me, I would personally want to pay myself more than what I'm paying the bank. So if that means I hold my home for 20 years and now I'm paying myself $1,000 a month and I'm paying the bank $200 a month, I understand that every single time I pay my mortgage, I'm closer to having a whole lot more equity to buy another home if I so choose, or to pay it off if I so choose. So whichever route I go is more beneficial the longer I stay in this home. And you have to take that into consideration. Now, certain things that will justify a move would be more space for the family, a better job opportunity that requires you to relocate to a better area or closer living situation. I've seen people who would travel an hour to go to work rather than leave their home in order to continue to pay down that mortgage and have more equity for themselves and their family later down the line. So, depending on how far it is, it may still be worth staying in the home as well. But as I was looking at the housing market, you have now seen interest rates drop down quite a bit. However, housing prices are still maintaining its value, especially in Columbus, Ohio area. But you see in places like Florida or California or even New York that housing prices are dropping more drastically because, again, the average buyer is not able to afford those price points in which those homes are listed for. Therefore, because those rates are so high, you're going to see more steeper drops. Whereas in the areas that I've bought, because they were on the lower end, they're still appreciating in value, and people are buying those up more so now than ever because they see an opportunity to where these homes are going to be worth $300,000, $400,000, $500,000 in 5 to 10 years, and they have no problem buying those homes now because they are what you would quote unquote say is undervalued if you're projecting outward. So, although I was hungry for a deal and I was looking at rehabs and using a 203K loan, which I'll say for a whole nother video, you gotta weigh the pros and cons. The 203K has higher rates. Is there still going to be equity in the home, especially in this market? And will I be able to make a profit because of all that's transpiring now with the economy and people losing their jobs? Is this the right time to get into one of those situations? So again, those are a lot of different questions to ask, which will be covered in later videos. So if you have any questions, comments, or concerns, leave them down below, and I'll see you on the next one. Peace.